Important note, this video is not financial advice. Always do your own research before making any investment decision. Past performance does not guarantee future results. Here's your market briefing from Rumour with AI. Stablecoin remittances are far from the frictionless utopia promised by crypto evangelists. A new mystery shopping study by the Bank of Italy reveals that costs for moving money via stablecoins range wildly from 0.3% to 9%. The culprit is not blockchain network fees, which remain negligible. It is the foreign exchange spreads embedded in the conversion process. For institutional players, this data point is critical. It suggests that stablecoins are not yet a cost-effective alternative to traditional SWIFT transfers for mid-sized corridors. The inefficiency lies in the fiat on-ramps and off-ramps, not the ledger itself. Meanwhile, the macro environment is shifting beneath our feet. Global equity markets are rallying hard on the back of confirmed Federal Reserve rate stability. The S&P 500, Dow Jones, and Nasdaq all surged as economic data reinforced expectations that the Fed will hold rates steady at 3.63%. This certainty has injected fresh confidence into investor portfolios. However, the bond market tells a different story. Gold prices fell 1.16% this week as U.S. Treasury yields climbed. The market is now pricing in a 63% probability of a Fed rate hike, a sharp reversal from previous dovish expectations. This divergence between equity optimism and bond caution highlights a fragile consensus. In related news, the geopolitical landscape for technology is hardening. The Trump administration has officially banned the import of foreign humanoid robots to shield the domestic AI industry. This move directly targets Chinese dominance in a rapidly scaling sector. U.S. firms like Tesla and Figure AI are the primary beneficiaries of this protectionist policy. The ban signals a broader decoupling in hardware supply chains, prioritizing national security over global efficiency. On the finance front, sophisticated capital allocation is evolving. A new proprietary equity hedge strategy is being deployed to manage a $700,000 asset allocation. This specific approach aims to isolate alpha while strictly managing portfolio risk in volatile conditions. It reflects a broader trend among institutional investors to move away from broad market beta toward targeted, risk-adjusted exposures. Looking ahead to today's release, the economic calendar remains notably quiet. There are no major high-impact releases scheduled within the next 36 hours. This absence of data allows the current market narrative to persist without immediate disruption. Investors are watching the Fed's 3.63% rate anchor and the 63% hike odds closely. Any shift in these probabilities will dictate the next leg of the rally or correction. The gold dip suggests traders are positioning for higher yields, while equities bet on stability. The tension between these two narratives will define the near-term volatility. That's your market briefing. Follow Rumour with AI for daily market intelligence.